Hi, I'm Jason with Level Up Investing, and in this video, I'm going to talk about the Walt Disney Company as an investment opportunity. So I've been a customer of Disney for many years, as long as I can remember, and I grew up going to Disneyland. I've seen a lot of the movies. I've currently been a season pass holder, annual pass holder at Disney World, which I live close to. So I've become very familiar as a customer. I wanted to do this video because I wanted to really take an in-depth look at Disney as a company that I could potentially invest in. So I'm going to go over it in three parts. One, I'm going to talk about the company itself, some of the key factors, including the assets that generate revenue with the company, the leadership, and the competitive advantage, and also a lot of the most recent news items that have occurred that have made the investment in Disney a very interesting potential. So that's the company part. The second part is going to be the numbers, or the actual finances. I'll be going over the financial statements and some of the SEC filings. So that'll be objectively the way to look at the company. And the third is the plan, or rather my plan, my investment plan with Disney. And it's going to be me pulling everything together to summarize and come up with an action plan that I'll be able to follow. So it's important to remember for this evaluation, my final evaluation, my final assessment is going to be based on a lot of the things I'm going to talk about as I go over the company itself as well as the financials. So it's important to watch the whole video so you can see all those details. That way the rationale that I come up with for my own investment at the end will make the most sense. And as always, keep in mind that this is my own research, my own evaluation, and it's my own investment. So this is by no means any advice to anyone, and I always recommend to do your own due diligence, your own investigation, your own research in order to make your best decision for yourself, for your investments. Okay, having said all that, let's start by looking at the company, and no better place to start than by looking at the annual report that gets submitted to the SEC, which is the 10K. So let's take a look at that. All right, so here is the Form 10K submitted by the Walt Disney Company to the SEC, and I highlighted there that this is for fiscal year ended September 28th, 2019. So Form 10K is the annual form, the annual official report that gets submitted. And this is different than a Form 10Q, which is the quarterly report. So let's take a look at this Form 10K, some of the key findings here. So on the Form 10K, I like to first look at the key assets that the company has. They'll often list it like this, not just the listing of the assets, but you can see right off the bat a summary here of the revenue and operating income. So with the Walt Disney Company, four major sections of the company when it comes to its assets. The first is the media networks. So these are the cable networks, the Disney channels, ESPN, FX, National Geographic, A&E. So they recently acquired 21st Century Fox, which was a big deal, and it plays a lot into the financials for the coming, for this year. There's also the broadcasting ABC TV network, and a part ownership in A&E, History Channel, Lifetime, many components of the media networks. So the second one is the parks, experiences, and products. That sounds pretty self-explanatory, I think, but basically the products also includes a lot of the merchandise, cruise line, so a lot of experiences, entertainment experiences, both domestic and international. There's the studio entertainment section, which includes the Marvel Cinematic Universe, Lucasfilm, the Star Wars films, Pixar, films like Toy Story, and of course Disney Animation Studios, which includes movies like Frozen and Frozen 2. Then there's the direct-to-consumer and international channels. So this is the streaming services that Disney Plus got launched in November of 2019. You also have ESPN Plus. There's now a 67% ownership in Hulu, This occurred after the consolidation with 21st Century Fox and also the 21st Century Fox international channels like Star. So this 10K here gives you an idea of the assets, and also you get a real snapshot here of where the majority of the revenues are, which we'll go to that in a second when we go to the numbers part. But you can just see a little bit of that right here. Another key point to look at is the competitive advantage of the company. So with Disney, I think it's pretty well known that it is an exceptional worldwide brand recognition involved, especially considering the brand names of Disney, Pixar, Marvel, Lucasfilm, and there's a very diversified entertainment experience between these assets like the media network, the parks, and the movies. And now with streaming, getting it all together in a bundle. And there's just been a loyal generational following with Disney. And as I mentioned earlier, I've been going to Disneyland ever since I can remember. So it's, and I'm taking my kids to Disney World pretty regularly. So there's a loyal generational following, and I really feel I understand the company and the products and services that they provide because I utilize them myself. Another key thing that I look at for the company is the leadership. So the previous CEO, Bob Iger, recently stepped down in February, and he is now the executive chairman through 2021. And he has handed the CEO over to Bob Chapek, who also has been with Disney as a senior manager, a senior level leader for 15 years as well. So that's good to know that the leadership is transitioning to someone who knows the company very well. So to me, that's a big plus. At this point, let's take a look at the transcript from the annual shareholders meeting, because from there you can get a really good glimpse as to the character of the leadership, because you always want to know about the leadership before you invest in the company. And one of the key quotes that I got was this. This is from Bob Iger, and he said, "These are challenging times for everyone." And so he's referring to the fact that during this meeting and during this time we're dealing with significant healthcare and financial issues, pandemic issues. So he's saying, these are challenging times for everyone, but it's also important to note that throughout our company's nearly century-long history, Disney has been through a lot, including wars, economic downturns, and natural disasters. And what we've demonstrated repeatedly over the years is that we are incredibly resilient. Our future has always been bright, and it remains so for good reason. In fact, when you think about the world today, what we create at the Walt Disney Company has never been more necessary or more important. So what I like about that is how much he is really trying to focus everyone on the direction of the company, as well as a reminder of the big picture of where the company has been and where it's going. So I think that's a very good indication of leadership style. And more specific to the direction of the company, he also noted in the shareholder meeting, as a company, the decision to pivot to our direct-to-consumer strategy was a critical one, and it is a top priority. And we're more confident than ever about the tremendous potential of our full collection of streaming services. ESPN Plus is off to a really good start. We're introducing new offerings on Hulu, including FX on Hulu. And also in this shareholder meeting, he certainly talked a lot about Disney Plus and how it recently was launched. And at the time that I'm recording this, they have stated that they're surpassed 50 million subscribers at this point. So moving on to the major news items, some of the big things that have happened at Disney in 2019. One of the biggest things was the acquisition of 21st Century Fox. And this has shown a lot of promise, as noted in the shareholder meeting, but also it has also shown significant restructuring costs, which have affected the financials, especially noted in the first quarter earnings of fiscal year 2020, which we'll look at in a second. The other major event is the closures of the parks and hotels because of the pandemic. And let's take a look at the Q1 first quarter 2020 earnings call transcript. So this earnings call was on February 4th of this year. Bob Iger, early on in the call, talked about some of the success with The Rise of Skywalker and Frozen 2, as well as the other movies, including Captain Marvel, Aladdin, The Lion King, Toy Story 4, and of course, Avengers Endgame. It's interesting what he writes, what he mentions here. Avengers Endgame contributed to a total global box office for the year for Disney of more than $11 billion, shattering the previous industry record of $7.6 billion set by us in 2016. So I thought that was really interesting. Also in the earnings call, the chief financial officer stated some of the hard facts that were happening at the time. So here she wrote, she's noted, at Shanghai Disney Resort, we currently estimate the closure of the park could have an adverse impact to second quarter operating income of approximately $135 million, assuming the park is closed for 2 months during Q2. And then you can see in the bottom there, she talks about Hong Kong Disney, how there have been the closures as well as just the overall decrease in visitors coming from China and other parts of Asia. And she wrote, she stated, these two factors could result in a decline in Hong Kong Disneyland's operating income of about $145 million for the second quarter. Again, this assumes the resort is closed for 2 months. So what's interesting there is how she has stated that's the projection for those two places. But what's really going to be important is the second quarter financials now that the domestic parks have been closed. So that's going to be, I think, very interesting to see what kind of hit the revenues and net income and, of course, free cash flow are going to have over the next couple quarters. Other issues that have happened in major news, there's the suspension of movie production, of which there are many movies that are in production. They had to suspend a lot of that, again, because of the current health issues. But aside from that, the big positive in news is the launch of Disney Plus, the streaming service, as people are having to stay at home and social distance. It started in the US and then has now moved into Western Europe, India, and as I mentioned, has surpassed 50 million subscribers at this point. So those are the key points regarding the company itself. And now let's go into the numbers. And for that, let's go back into the 10K. Okay, going back to the 10K, you can see the selected financial data here. And looking at the top line, the first thing that I notice is that even going back and looking at other sites and looking at revenues from even way before 2015, so it's pretty clear that this is a stable company. And on the top line, you can see from 2015 up until 2019, a pretty steady increase in revenues. And looking back at the breakdown of those revenues, you see that the majority of the revenue, we saw this chart before, the majority of the revenue comes from the media networks as well as the parks, experience, and products. But when looking at the numbers, looking at the revenue is important, but then it's also important to compare to the net income trend. So you're seeing that in the third line there, that although the revenues increased from 2018 to 2019, this is the annual numbers going from 59.5 billion to 69.5 billion revenues, the net income went down. It went down by about $2 billion for the year. So it's important to keep that in mind, that although the revenues are up, the net income is down. And why is that? That's because Disney had a very expensive year of 2019. And so you take the revenue, which is what monies came in, and you had to subtract a lot of the expenses. So to get the net income. So in the 10K, they also note here, we have incurred and expect to continue to incur significant costs, expenses, and fees for professional services and other transaction costs in connection with the TFCF acquisition and integration. We may also incur accounting and other costs in the integration of the business of TFCF which is 21st Century Fox, that were not anticipated at the time of the acquisition, including costs for which we have established reserves or which may lead to reserves in the future. Such costs could negatively impact the company's free cash flow. Well, it definitely negatively impacts, and you'll see that in just a second. So it's important to see the revenue change as well as the net income change, and to see why, and that is a big reason why. So if we go back to the Q1 2020 earnings call, we also notice that here in the following table, this is from the first quarter earnings, in net income, the net income is down by 23% year over year for the quarter. Again, that was the fiscal year we talked about earlier. This is just the first quarter, October, November, and December. So 23% decrease year over year in the net income. But what I feel to be more striking is at the bottom there, the free cash flow also has had a significant change of a 68% change year over year, a decrease. And in the earnings report, they state how these numbers are due to higher production costs, as well as restructuring payments and higher capital expenditures. So a very expensive year, and it's reflected in the financials. Going back to the selected financial data from the 10K, the other thing that I tend to look at is really not just the earnings, the net income, but also the quality of the earnings. What I mean by that is that I'm comparing the net income, which is that third line, going from 2015 all the way to 2019. I'm looking at that and I'm seeing, okay, you know, it's increased and then it decreased in the last year. We just talked about why that is. But then we also want to look down at the free cash flow. If you look down there under cash provided by operating activities, you'll see that also did the same thing, only the free cash flow significantly dropped from 2018 to 2019 to the tune of about $10 billion. So quite a difference. And when I talk about quality of earnings, I'm looking at the free cash flow to the net income ratio. I take that operating activities cash flow number divided by the net income, and that's telling me that out of the net income, how much of it is actually free cash flow, how much of it is actual positive or negative cash. And so in the current year, the ratio, which is very low compared to historically, Disney has been at a free cash flow to net income ratio of 0.71 to 0.90. So significantly different this past year. I also look at the quality of the PE ratio. So a lot of people look at price to earnings ratio and decide on investing based on that. For example, if the price to earnings ratio is below 20, then it's a good investment. Some people go by that. Well, I also want to look at the fact that PE ratio, currently the PE ratio is at 17.59 for Disney. You take the price, you divide that by the earnings per share. But then if you, instead of looking at the net income as the earnings, which is what the PE ratio is based on, instead of that, I like to try using the free cash flow instead. So it turns out that the net income in 2019 being, as you can see there, about $10.5 billion. Well, if you utilize the free cash flow number instead, which is down there about $6 billion, then the actual price to earnings ratio based on cash flow is actually higher. So that may be higher than what you think it is. So that's something to also consider, that the free cash flow is significantly decreased, and that can potentially change your numbers. And for me, that definitely factors into my investment decision making. When we look at the key numbers here on the balance sheet, we also see that the total assets have more than doubled since the past year, and again that takes into account the acquisition of 21st Century Fox. But also you can notice right below that the long-term debt obligation has also more than doubled. So you may see those numbers there, you may think what's going on, but we have reasons why that has occurred. So significant debt, but it is it's a strategic acquisition play that Disney did this past year. So the leverage is up, debt is up, and free cash flow is down. So looking a little bit more at the free cash flow at the bottom there, you can see that the annual free cash flow, as we mentioned, significantly dropped by 2/3, it looks like, compared to the previous year. And the investing cash flow also tripled, essentially. And so again, it is investing in this acquisition, but because of that, the free cash flow from operating has significantly decreased. So now, based on the company's information, the data, the news, the qualitative factors, and the financials, the more quantitative factors, I like to, at this point, come up with the plan, which is where I bring all of that together. So overall, based on all of these points I've shown you, I'm looking at Disney as a good long-term play, and it's a good long-term play with very high brand recognition and a lot of potential for a lot of great things, revenue generating assets, a lot more revenue in the future. However, this is a company that the financials have not done well this past year, and we know why, because of a very expensive year between the acquisition of 21st Century Fox, as well as the company pivoting to the streaming platform, Disney Plus, and ramping up with increase in ownership of Hulu. So a lot of different things happening that Disney, I believe, is really thinking about the market, looking at where it's going, looking at where entertainment is going in the long run, and making that investment now. So I think on initial review of the financials, it may look rather intimidating, and when you see the free cash flow going down and you see the long-term debt going up, but I like to think about the long-term horizon as to why that is. We have a reason why that is, which we just described. And so that's why I think it's a good long-term play. I also think it's a good long-term play that is just having a difficult time right now because of the pandemic, and which could really make it a buying opportunity, because the value of the company for me is high. And as the price goes down because of these external factors, the pandemic, which I believe is going to eventually pass and everything will get back to normal, then right now would be a time that I could buy some of these stocks at an undervalued price. What's going to be key is the second and third quarter of this fiscal year, 2020, to really see what's going to happen, because nationally you have the jobless rate increase significantly to historic levels, and so you have people being laid off. Are people going to be able to, or when are they going to be able to go on vacations again? When can they go to Disney World or Disneyland, or go on a cruise? A lot of it may be more towards them getting their entertainment through the streaming, as opposed to the in-person experiences. So that's, again, why I like Disney, because they've diversified their experience, their entertainment experience, that I think most people can still take advantage of. So it is going to be interesting, though, over the next 2 quarters to see what the revenues look like, what the net income looks like, as well as the free cash flow. So speaking of the free cash flow and the actual investment in this company, what I've done is I've done my calculation. I've taken the past 10 years of free cash flow, historic free cash flow, and from those numbers, I've done my own projection. I am a little bit more on the optimistic, positive side, again, because I know Disney, I've gone to it, I've been a customer, and I know it's going to be around a long time. So I've taken a more optimistic approach on the growth rate in the future. From that growth rate, I've determined what my rate of return would be if I buy at the current price, which is $104.50 per share. So I've come up with an internal rate of return of 3.2% after my calculations. This is based on the current sale price, the current stock price, as well as my projected future cash flows. So when I think about opportunity cost, I think, could I instead invest in a 10-year treasury bond? Well, the current rate right now, you can see here, is at 0.73%. And you take that and you also look at the US inflation rate of 1.5 to 2.3% over the past 5 years. So based on that opportunity cost, I've determined that if I can get an internal rate of return of maybe 5 to 6% on Disney, based on my projection of cash flow, then I think that'd be a good place to be. So at this point, my buying strategy with Disney is based on my calculations. My current buy price now is lower than that. It is more in the $80 range. Low 80s probably. So what I'm going to do is I'm going to hold my current position with Disney, and then over the next quarter or two, I'm going to see what the free cash flow is looking like based on their operations, based on parks reopening, based on movie production resuming, and to also see how the live streaming is going and how that revenue is going. So I'll be looking at the quarterly earnings reports very closely, and that will help determine really how much further I'm going to get in with Disney as an investor. So currently, as a value investor, I will wait and see the stock price and see if it drops down to my target, which is approximately $80 a share. And if that's the case, if I buy it at that point, then I'll be looking at about a 5% rate of return. Hope that makes sense. If you like this kind of content, definitely give me a like on the video. That certainly helps. And leave a comment and let's interact, and go ahead and subscribe if you haven't already. And I look forward to seeing you on the next video.